when you're looking at your digital banking stack and you're trying to figure out what's nice to have versus what must I have, I think you start where you start with a lot of things, which is, well, what's the competition doing? So you need to look at the market, you look at what the competitors are doing, and if you're surrounded in your particular area, maybe it's a geographic area or the market that you're trying to target, and you see kind of a set of features or offerings that virtually all the competitors in your area offer. I mean, these are the people that you're going to be trying to take their customers away from them, right? So you're going to have to determine what is it that's available to those consumers or maybe even small businesses, and what do we have to have a competitive offering. Another thing, let's just assume then once you have parity with your competition, then you need to decide, well, okay, I'm looking at some of these newer things. Maybe it's I want to offer crypto offerings to my customers, or maybe I want to offer them certain sort of financial wellness or money management tools. At that point then, if no one else offers it, you may want to look at what the product adoption will be. So I would say that a good mark would be something if you don't feel like at least 10% of your customers will actually use that particular product or service, it's probably just a nice to have. But if it's something where you believe it's above 10%, or you look at it and you say, all my competitors offer this, I would say it's a must-have if you want to be successful. So in retail banking, some of the most overlooked kind of revenue and profit drivers that I think that a lot of bankers don't really think about, or at least they're generally speaking in the industry, we're not doing a good job of taking advantage of it, is really the existing customer base and expanding the wallet share and relationship within that. It's roughly 7 times easier to sell to an existing customer as it is to actually acquire a new one. So what you have to look at is, how many accounts per customer is a lot of things that one of the stats that a lot of banks track, but really looking at the services and products that they have with you, and really you have to know that they've got other products and relationships with other either financial institutions like traditional banks or credit unions, or even with like fintechs. So it could be PayPal or Square, or Venmo, or it could be Robinhood or any of these other ones. One of the things that customers can start doing right away is really making use of the data. Like one of the best things that some of our customers do, they look at that transaction information that hits their core, and they can identify like ACHs that come in from Venmo or PayPal or some of these others. And then they actively take that list and market to those users saying, hey, did you know we have Zelle, for instance? We have these types of solutions. Because those other companies, if you're not expanding the relationship, just know that those other companies are. And PayPal and Venmo are really classic. It's starting with a free payment service and now offering checking accounts and savings accounts and other types of things. So you really have to watch out for that. But really the most amount of untapped potential is your existing client base. I would say that the hard truth is you really have to default prioritize the customer experience. One, I mean, you're in business for the customer, so that's one reason. But the other reason, just from a dollars and cents perspective, is it's much easier to find the justification, the ROI, whenever you're doing something more for the entire customer base, for a couple of reasons. One, there's just the numbers are on your side. So, little bits of changes can make big differences when multiplied times thousands or hundreds of thousands of people. The second reason is that if a really key part of your strategy is growth, having something on the digital front end that allows a customer to self-service is really key, because it's the only infinitely scalable service model, self-service. So it really sets you up to be able to scale as an organization. When it comes to the back office, though, there are definitely certain things that maybe for employee sentiment or just because it bothers you to be inefficient or whatever, that you can look at. I think the key there is that it's going to have to, whatever it is you're looking to do is going to have to cost a bit less in order for you to really have that justification or the ROI on the back end of, 1 or 2 or 3 FTEs. So it's going to be something that it's going to probably take a little bit more scrutiny. So I would say default on the front end. Now, once you get that all squared away, then kind of look to the back office. So as we look kind of, let's say, near-term future, and there's talks of recession and other things, people may be thinking, well, how does that affect digital banking, and where should my investments be? The good news is, at least from a digital banking perspective, is that it is the most sound investment that you can have, right? Because it ultimately is your lowest cost channel for sales or service. So if I look at potentially like a branch footprint that may cost $1 million and then another $1 million a year just to maintain it, and maybe that branch gets a couple of hundred people a day that go through there. Well, if you're a 100,000 customer bank, you have 30 to 40,000 of those customers that are logging in every single day through your digital banking channel. So I think that if times become leaner, let's say if it's the next 1, 2, 3 years, I think what you're going to see is an acceleration in the investment in technology, because there's just a lot more efficient, it's a lot more scalable, and I think that what you're going to see is either a pause or maybe a pullback in the amount of investment that goes in the physical service channels, primarily branches.